Real estate investment practice problem using OneNote. Points explained and analyzed, part 1. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab, down in the 4180 Points Explained and Analyzed Part 1 tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got the information up top, calculations on down below. We're looking into points which conceptually are fairly straightforward, but then when we actually think about the calculation of points and the comparisons of whether or not it would be beneficial to have points or not have points, and comparing one loan that may have a different point structure to, say, another loan, it can get fairly complex. So we're going to go through some of the tools that we can use and the concept of what points are here, and then we will use those tools for some more analysis in the future, including the break-even point, what the break-even point is, how these types of concepts and tools can help you to make decisions about your loan structure. So note, we also do this in Excel, and Excel, we're going to have more formatting involved, so it'll be a little bit longer of a discussion there. But if you think this is worthwhile to calculate in Excel, you can do so along with that presentation, and or if you want to use the Excel worksheet, in essence, the answer key that we come up with there for your own decision-making processes, you can take a look at it and see if it would be useful to you as well. So the points and the concept that we're talking about points here is that basically the idea is to pay down the rate of the loan. So the idea then would be that you put money up front, and that money up front is going to basically result in a pay down of the loan or reduction in the rate to the loan. The main reason this could be beneficial, you might say, well, why would I do that? Because now I'm paying money up front, and the whole point is I'm trying to get a loan here, right? Why now I'm going to pay more up front? Well, the lower interest rate will typically be the biggest factor that can result in the payment being lower. So it can be useful when you're looking into the future and trying to say, I'd like the payment as low as possible so that I be more secure that I can make the payment. That's one of the major factors that will be involved. But then there's, of course, the question as to whether it's going to be beneficial in the long term in terms of total dollars and possibly time value of money. Is it beneficial or not to put the money up front and then pay down the rate? And how does that work out? So then we have some comparisons that could be a little bit tricky there, because now when you make comparisons, you have this different rate with the points, the lower rate, but you have that upfront cost that's going to be involved for the purchase of the points, which can kind of confuse the comparison. So we'll look at some tools to wrap those things together in essence. The other thing that can confuse the comparison is if you get, say, a 30-year loan, but you expect that you're going to be selling the home or selling the property or something like that in 10 years. Then the tools that we use to do a comparison to see whether it would work out well in one scenario to the other, because we have a shortened amount of time that we're actually going to be using the loan, gets a little bit more complex in those scenarios as well. So we'll take a little look at them in the future. And then there's also just noting to point out, when you think about the ideas of what your options are with points, if your options are either to have points, you can buy down the rate of the loan to have points, or you could say no points, not purchase the points and have the loan rate where it stands. The third option is to say, well, if I had the money up front that I could be paying down the loan, you could put that down, in essence, more of the deposit, paying down the actual loan amount. That's kind of the third option, which isn't really thought about or analyzed a lot of the time. It's usually a comparison between the two, points or no points. And so that's the third option, to just realize that obviously there's, you could pay down the loan. Paying down the loan typically will not result in as low a payment amount. Paying down the interest rate usually results in the lower payment amount, and that's kind of the purpose for many people, to try to get that payment amount down to what they think is a budgetable payment amount, even though that's not the only factor, of course, because you got to consider whether or not it's beneficial just from a cash value with regards to total payments. So those are basically the concept of points. So what we're going to do here is get a better idea of what points are, and then how we can use them in our analysis in Excel, and then we'll use those tools to basically analyze the points and different decisions more thoroughly. So here's our information. We got the home value. I'm not going to put anything down this time because we don't want to complicate things. We just want to have the loan amount at, in essence, the $200,000. So loan amount $200,000, 30-year loan, 360 are going to be the months. And then we're going to have the rate. We're going to assume this is the rate before you have the points involved. Then you're thinking, okay, can I pay down that rate with the purchase of points? Then if we add this to the worksheet, I'm going to add the points down here in terms of the calculation of the points. Now, usually, and this could depend on the lender, they might have different things going on, but usually you get like 1 to 3 points possibly that you can get depending on your circumstances. And the point, by definition, and this is basically universal, a point means 1% in essence of the loan amount. So the loan amount, if you had 1,200,000, if that was the loan amount times 0.01, we would expect the point cost to be 2,000, meaning 2,000 is what you would have to pay up front in order to pay down the rate of the loan. Then the question was, how much is the pay down of the rate of the loan? We're going to assume it here to be 0.25%, not 25%, 0.25, 0.0025, or 0.25%. That means if you, and that's not, that could change. That could, you got to see what the conditions are going to be in your circumstance. But if that's the case, then if you bought then 1 point for 2,000 and you got a 0.25 decrease, your rate would be going from 5% minus the 0.25 to get to the 4.75%. So that's the idea. You put money up front and you pay down the rate, and when you pay down the rate, then that would be decreasing the payment amount. Then the question is, well, when does that pan out in terms of total dollars, and considering the fact that, yeah, my payment amount is less, but I just put $2,000 up front in order to get that lesser payment amount. Does it work out over time? And if so, what's the time frame in which it becomes a beneficial thing to do? So that's going to be the general idea. Now, note that once we have these two items here, if I had points and the interest rate, meaning I paid for points and then I have a lower interest rate, that becomes more difficult to compare to other loans where they have a different point structure and interest rate structure, because now you're talking about two different things. It's kind of like when you compare job performance or something like that. We got to use ratios typically, right? So if you're comparing batting averages in a baseball or average shots on a basketball or something like that, you've got to use a ratio to do the comparison to see how many shots, how many free throws were taken, or how many at bats were at bat. And the same thing happens here. If you've got these two things, you can't really compare them very easily. We would like to combine them together into one ratio, in essence 1%, and that's going to be the effective rate. So that's one of our tools. It's not the only tool. It's not the thing that's just going to solve all of our problems, but it's one tool that we can use in our tool belt to kind of figure out what would be the best strategy for us. Okay, so once we have this information, if we were to put this in Excel and properly format this, it will then generate the amortization table for us. This amortization table is starting off without any points, and the payment then being $1,073.64 about, which we're going to say just $1,074. That would be the payments, interest, loan amount. This is what we're going to have in terms of our structure. And of course, it would populate the entire 360 as we have seen in the past in our practice problems. Then what we're going to do in our first kind of worksheet here is we'll actually copy and paste the entire thing so that we can have a side-by-side scenario. And on the second scenario, then we can add the points. We're going to say 3 points here, purchasing 3 points. If we purchase 3 points and the loan is $200,000, and each point it means 1% of the loan, so times 0.01, that would be $2,000 per point times 3. That would be $6,000. So we'd say, okay, we put $6,000 up front. What did we get for that we had to pay up front? And note, when I say up front, that means we paid for it up front, meaning we didn't roll it into the loan. The loan balance is still $200,000. It's not like we said, okay, now I got 6,000 points. I'm just going to increase the amount I owe to 206,000. No, we paid, you paid the points. That's going to be the general structure here. And then you're going to get the reduction in whatever they claim, whatever they say the reduction will be. We're going to say 0.25. In this case, that means that if we had this 5% minus 0.25 times 3, which would be 0.75. So in essence, that would be 5% times 0.75, and that would give us the 4.25%. So now our rate is going to be 4.25. So in other words, we paid $6,000 upfront to pay down, as they say, the rate from 5% to 4.25 on the same loan balance, which is still at the $200,000. So that's going to be the idea. Now, note then, again, we have these two items here that are going to be the points and the rate, which are difficult for us to compare. If I was to compare that to some other loan that, say, just had a rate that was involved, it's a little bit difficult to make the comparison there. To make the comparison, one tool we use is the effective rate. So I could say, is there a rate, kind of like a ratio that we would use, like a batting average kind of thing, that I can make a comparison between two different things that are structured differently? And that's going to be basically what we'll call the effective rate here. So the effective rate can be calculated with the rate function, and it would look something like this. We'll do this in Excel if you want to take a look at it in more detail. It's going to equal the number of periods. It's the rate function, number of periods, which would be the 360, comma, the payment amount, which is now has been restructured. Notice the payment amount went down to 983.88 about. That payment amount needs to be a negative in order for this formula to work out properly, comma, the present value. And here's where kind of the trick is. You see the subtraction problem. If we put the 200,000 in, then it was, and then multiplied it times 12, because that would give us the monthly rate. We'd have to make it the yearly rate. That if we just put the 200,000 in times the whole thing times 12, we'd get 4.25. But we're going to add a little twist here. We're going to take the 200,000 minus the amount of the points that we put in for the present value, then take that entire thing times 12. We get to 4.51%. Now, the reason you're doing that is because really what happened at the front end, what happened is that 200,000, you can think of it as a cash inflow, and then the 6,000 is a cash outflow. And you might say, well, I didn't get the 200,000. What do you mean it's a cash inflow? Because you got the loan and then you paid that to the seller in order to get the home, right? So it's kind of like you could think of it as if they gave you 200,000 and then you took that 200,000 and paid for something with it, the home. So it's kind of like from a loan standpoint, that's the cash inflow. This 6,000 went out. It didn't go to the seller, right? It went to the finance company to pay down the rate. It's a prepayment of the interest rate. So this 6,000 is an outflow. So really the net inflow 200 from the loan is 200,000, which we bought the home with, minus 6,000, which we had to pay. So it's a net of 194,000. So notice, even though the amortization schedule is being calculated on the 200,000, which is proper, really the cash flow that happened up front is the 194,000, and that's how you can get this basically effective rate. You're kind of rolling in these two things into one kind of ratio, or one, in essence, rate to pick up that amount. Now, note that this works quite well if you're having the loan for the entire 360 or 30-year period. That becomes a quite good number, accurate number, to see if this actually pays off. In other words, there's a couple benefits you got here, right? One, you paid down, you put 6,000 up front, but you got in return for that the reduction in the payments each month. And that's generally, from a budgeting standpoint, kind of the idea. If I can get that thing locked down as low as possible over 30 years, I think I can cover that. That's what most people are first thinking. Then the question is, well, is it actually beneficial from a financial standpoint for me to pay down the interest rate, considering I had to put $6,000 up front in order to do so? Well, this rate gives you an idea of that, because the total rate here is less than the rate if you didn't have the points and it rolled in these two costs to it. However, this is being calculated working out on the entire 30 years. So the question here is, the problem is, of course, if you paid the $6,000 up front and then you sold the home a year later or something like that, then the difference in the payment amounts has not yet been long enough for it to materialize as a benefit, most likely. So the longer you have the loan, the more likely it's going to be that paying down the rate is beneficial. If you expect to have the home for a shorter period of time than the 30 years, then you might want to think about what is the break-even point. What is the point at which the two scenarios would basically be break-even in terms of time value? We'll take a look at that in future presentations. If you have an idea exactly of how long you're going to hold the home or the property, if you're saying, hey, I'm going to hold it for like 3 years and that's it, I expect to basically sell it within that time frame, then you're even though you got a 30-year loan possibly, you can figure out basically what the effective rate is at that point in time. It's actually a little bit easier than figuring out the break-even rate, at that point. So we'll use the tools in order to do that. So let's scroll on down here. This is the 30-year amortization table with the points. Now, if you compare the two amortization tables, this first one was with no points, second one with points. Notice the loan amount is the same for each of them, although on the second one, you still paid $6,000 up front. It's not included in the loan amount. It was a cost that was in there. The big benefit you have then is going to be the payment amount is going to be less when you buy the points. That's great. And then there's also going to be a difference in the interest because there was a difference in the interest rates that are going to be involved. Now, the tricky thing about this, when you're trying to figure out what will happen in terms of a shorter than 30-year time period to basically see if it's worthwhile to buy the points, is that normally when we calculate the break-even point in kind of a simple type of method, we can take the difference in these payments and see how long it takes for that difference in the payments to pay off the $6,000 in our case for the points. But it's a little bit more complicated given the fact that if you were to sell the home, say after a year, because of the different interest rates, you've got different loan balances. So the first one has a higher loan balance of $197.49, and the second one $196.628. And obviously, if you were to sell the property after that point in time, you'd have that cash outflow that you'd have to pay off the loan before you got the proceeds after the payment of the loan. So that kind of needs to be taken into consideration if you're doing a more in-depth type of analysis between a couple different scenarios depending on what your circumstances are. That's when it gets a little bit more confusing. Now we'll put some tools down here that we're going to use in order to do this. These are going to be some cash flow kind of tool concepts, time value of money concepts. They could be a little bit confusing, but they're also in some ways quite intuitive. So I want to look at these tools and get an idea of what they mean, and then we can use those tools to help us out with our decision making in the future. So this is a typical kind of time value of money type of calculation that would be done for long-term type of decision-making processes. What we would do is just take basically the number of periods. This first one is starting off with no points, and this is just to prove what the tool actually does, and then we'll use that in the scenario with points, and that's when it gets a little bit more confusing. So in other words, if you were to take the time periods 1 through 360 and then list out the actual cash flow that's taking place, which means you're going to have a $200,000 basically inflow because that's the money you got from the loan, and then you paid for that to buy the home. You didn't actually put it in the bank account, but they used that to pay for the home. That's the inflow. And then we had the outflows of the 1,074 for 360 periods or 30 years monthly. And then if we present value that entire thing, discounting it back at the loan rate, which in this case was the 5%, we can get an idea of what this present value calculation is going to be using. And again, I'm just getting an idea of what the tools are so we can conceptualize basically what that effective rate was and what the tools we can use if there's going to be a shorter time frame might be. So if we took each one of these items, and this is quite easy to do in Excel, although it looks very kind of overwhelming here, but if we took each one of these items and present valued it back using a present value calculation, which would look something like this. For this first one, let's look at year one. We've got the 1,074 that went out, negative present value. We take the rate, which we would pull from our data up top, which was 5%. We make that absolute so I can copy it down. Then we're going to divide that by 12 because the 5% is a yearly rate and we want a monthly rate, comma. the number of periods, we're going to pick right to the left-hand side, which is that number 1, which makes it nice and easy to copy down if you set up your table in this way, so it'll move down to 2. When we go down, that represents 1 month. And then we're going to say, comma, the payment. There is no payment because this is not an annuity. This is a present value of 1, 2 commas, therefore, and we got the future value, which would be that 1,074. So in other words, if I discount that 1,074 back 1 period, in other words, 1 month, at a rate of 5%, that's the yearly rate. Monthly rate would be 5% divided by 12. We would get to that 1,069. If I did that for the second one here, just copying the formula down, it would be negative present value. The rate would still be the same cell, 5%. That's absolute reference, meaning we copy it down and it doesn't move down. Divided by 12 to get the monthly rate, because the 5% was the yearly rate, comma. Number of periods is now 2. That cell moved down from U3 to U4, and then and that's 2 months, representing 2 months, comma. No payment because it's not an annuity, 2 commas. And then we have the future value, which is the 1,074. Again, discounting the 1,074 back 2 periods, 2 months, at 5% yearly rate, 5% divided by 12 monthly rate would give us 1,065. Now, if I did this all the way down on just our normal loan without the points being involved, we're going to get down to the 0 if I was to add up my present values. In other words, if I add up the cash flow, we have a negative cash flow. We got the 200,000 up front, and then we pay this 1,074 over the life of the loan. So in other words, if you think about the loan, we got 1,074 about, this is rounded, times 360 payments, that much, and then minus, we purchased the loan and we got up front to pay for the home 200,000. So we got the difference here. Again, it's different because of rounding involved in those payments. So there we have that. But if I look at the present value, which I discounted back at the 5%, it adds up to 0. That's what the kind of 5% means, or how it works out. The tool I want to point out here is the IRR tool, which stands for the internal rate of return, which is a tool that we can then use for these kind of scenarios that are going to be shortened type of scenarios, not for the entire 360. Meaning, if I was to use this IRR formula, which is an easy formula to calculate if this thing is set up properly, in this case, positive numbers for the inflow, 200,000, negative for the outflows, equals IRR, and then you just like sum up. It's the same as the sum function, the series of data down from 1 to 360 periods. That would give us the 5%. So that gives us the 5% nice and easily there. And if I had some period other than 360 that I'm planning on holding onto the loan for, I could use this IRR formula. So in other words, the IRR, the internal rate of return, represents the rate at which this series of payments, if you were to discount it, would add up to 0. So we present value everything. It discounts down to 0. The IRR, internal rate of return, is the rate at which that happens. So now look at our scenario where we have points that are going to be involved. So now we have our points, and we're going to switch this up a little bit, which complicates it a little bit, right? We're going to say the starting point is not 200,000, which is the loan amount. But when we look at it from a cash flow standpoint, remember, we really got the 200,000, which we then used to pay for the home. And then we paid to the lender for the prepayment of the interest points, the 6,000. So the cash flow in period 0 is a net inflow of actually 194,000, even though the loan amount is 200,000. So looking at it from a cash flow standpoint, we have the 194 up top, and then we have the amounts that are going out, which are now the lower payment amounts of the 984 all the way down. If we did the same thing, if we were to discount these items back and discount them back using the, I believe it was 4.25 instead of the 5%, meaning the rate after we took into consideration the points, we're still not going to come out to it being 0 at the end. In other words, if I take each of these items, we set up the amortization table with a $200,000 amount, and then we used the rate after the points, which I believe was 4.25, in order to amortize down to 0. Now we're twisting it. We're putting that twist in place to say, well, really, the cash flow up front was 200,000 minus the points, 194. And then if I look at my payments that we made and we discount it back using the rate of the 4.25, we're not going to get then to a 0 down at the bottom in terms of our cash flow because of that change. We're differenced by that $6,000, which was the amount of the points. So you could see the difference in terms of total payments here. In terms of total payments, at the end of the 360, we're looking better with the points than without. But again, the question is, when does it turn out to be better if we were to have less than 360 periods? But in any case, we're using our tools here. If I used our internal rate of return tool to then basically IRR equals IRR, everything not including the total from the starting point on down to this last payment, that would then give us the 4.508. Now that, if I go all the way back up to my data up top, 4.508, you'll recall was the effective rate that we calculated way up here somewhere, way up here in our data. There's the 4.51, we rounded it to 2 digits, the effective rate. So this is just another way to calculate the effective rate, hopefully giving a better idea of what the effective rate is. But again, this IRR tool is a tool that we can use to kind of calculate what the rate would be if we had something other than the full 360 time periods that we plan on spending. So we want to know how to use this tool so we can have other scenarios that we can then work out. So in other words, if I was to take this number that we came to, that 4.508, and then we use that, because remember what that means. That means this number, this rate, not the 4.25, but the 4.508 is the number at which this series of cash flows, if discounted at that rate, would result in 0 at the end. That's why these two rates could then be comparable. So in other words, let's just take a look at one more calculation to understand that. We're going to say, what if we took this same series of payments with the points, but instead of discounting it back using the rate that we used to amortize the loan at, the 4.25, we use the IRR we just calculated, the 4.508, which is higher, of course, than the 4.25. And then we discount this back, present valuing each of these payments back at the 4.508 discount rate using the similar formula with the present values all the way down. That then should result in us summing up the payments here and getting to a 0, meaning that sum of cash flows discounted at that 4.508 results in 0 because that's what the internal rate of return is. So now that we have this internal rate of return, we can compare this. We could say, yeah, that makes sense that over the life of this thing, I have a rate that's comparable, and I could say it would be beneficial for me then to buy the points, getting both the lower rate and being able to basically have a net benefit in terms of like the internal rate of return. It'd be financially good for cash flow purposes as well over the time frame. And then, of course, the other question would be, can I afford to pay the $6,000 upfront would be another kind of question to have. Now that we have this tool, then we can look at the more complicated kind of questions, which would be, well, what if I'm comparing this loan to another loan which is structured without points or has some different point structure that's going to be involved? And or what if I expect to have this loan not for 30 years because I expect to sell the property before that? How can I use the IRR to determine a comparable rate sometime in the middle? Because this IRR will be different for every time period within the loan amount. So you'd have to figure out what that is. And then you can also think about what they call the break-even point, which would be the time at which you would think it would be beneficial to buy the points or not, or it would be neutral to buy the points or not from a cash flow standpoint from that one factor. So we'll take a little bit more of a look at those in the future. We'll also try to think about how to use these tools with the help and use of pivot tables to see if we can work with something that's not going to be exactly the 360 periods, and so we can do less copying and pasting. Remember that we do have this information in our Excel worksheets, so you can work these problems in Excel, get a feel for what these tools actually are doing, and or use the Excel worksheet for your own decision-making purposes if you think that would be helpful.